My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to demonstrate the solution for exercise 17.8 from the Spiceland textbook. Okay, so we already have exercise 17.8 drawn up here. We have most of the information that we need for Sterling Properties to complete the defined benefit worksheet. However, there are two additional pieces of information that I need to add to the problem. One is that we are going to assume that there's $50 million, $50 million in cash contributions that are being made during the year. And we're also going to assume that there are $70 million in cash payments or benefits paid out during the year. Okay, so that's the additional two pieces of information that's missing from this problem that I'm adding here. So we've got $50 million of cash contributions being made by the employer, and then $70 million of benefits that are being paid out by the employer. Okay, so what I'm going to be doing in this problem is flipping back and forth between the data in the problem and that defined pension benefit plan worksheet that we have. All right, so let me flip over to the worksheet real quick here. And we can see that everything is blank to start with. And where we typically will start with the defined benefit plan worksheet is in identifying the beginning of the year balances. Now, this worksheet I've designed to accommodate more than just exercise 17.8. It's been designed to accommodate a wide variety of defined pension plan problems, and so we may not use everything that is in this worksheet. But where we are going to start for purposes of this course is with the adjusted beginning balances. We do have two rows above that, beginning of the year balances, and then a line for additional prior service costs from a new amendment. None of the exercises that we will be illustrating in the course are going to have new amendments. We just don't have the time to discuss that in class. And so we are going to be starting with the adjusted beginning balances. And so what we need to do is identify the beginning balances of our current balance sheet items, as well as balances in the plan or trustee administrator accounts. Okay, so let's flip back over to the exercise here, and we can see that, for example, the projected benefit obligation, the PBO balance on January 1st, 2013 was $850,000. Okay, and so I'm going to go ahead and insert that in my worksheet. That's an $850,000, I'm going to leave the thousands off, but $850,000 credit balance. Notice here that the projected benefit obligation is always a credit balance. It is an obligation, and so we can think of it as a liability. Even though it's on the plan, trustee, or administrator accounts, it's not actually an employer's obligation. It's on the administrator account side, but nevertheless we can think of it as a liability, and so it has a credit balance like any other liability that we would expect. Now, we also need to know what the plan assets are at the beginning of the year, and those are identified right here. Plan assets, January 1st, $900,000. So I'm going to insert that in my worksheet as well. Now, that is going to be a debit balance. And now, once I know what the beginning balances are for the plan assets and the projected benefit obligation, remember that we discussed earlier that the difference between the plan assets and the PBO, the net amount of the difference between the two, is what actually shows up on the employer's balance sheet. Notice that these two columns here are separated from everything else. This is what's happening on the administrator side. This is what's happening on the employer side. And this is one of the rare circumstances where US GAAP allows netting of assets and liabilities. This is very rare and part of the negotiation process that ensued when they were developing this set of standards for accounting for pensions. In any case, we are going to take the difference between the beginning balances here of plan assets and the PBO, and that's going to be either our prepaid pension asset, which is very rare in real life, or an accrued pension liability. In this case, we can see that the plan assets exceed the PBO by $50,000, and so in fact we have a $50,000 debit balance here. And so that's the first step in navigating our way through the worksheet. So we have a $50,000 debit balance, and that's because plan assets are exceeding the PBO by $50,000. Now we also need to know what beginning balances are of any other related pension accounts. We probably won't know the cash balance, so I'll just put X's in there. And then we need to know if there are any carry forward accounts in AOCI. And there are two types of carry forward accounts in AOCI. There's either a net gain or loss and unamortized prior service costs. And those will simply be identified. If they exist, they'll be identified in the problem. So for example, prior service costs is in AOCI. We can see that that is an AOCI account, accumulated other comprehensive income, and it has a balance of $80,000. So unamortized prior service costs has an $80,000 balance, and notice here that unamortized prior service cost is always a debit balance. It cannot be a credit balance. It's always a debit balance. Then the last question is, do we have any net gain or loss that's being carried forward? If there is a net gain that's being carried forward in AOCI, that's going to be a credit balance. And if there is a net loss being carried forward, that's going to be a debit balance. So in this particular case, we have a net loss in AOCI, and that balance starts out with $101,000. So there is a $101,000 loss being carried forward, and losses are debit balances. So those are the beginning balances of all the accounts. Notice here that I am not concerned with the order in which data is provided to me in the problem. I don't care about what order the data is provided to me in the problem. What I need to do is pick through the data in the problem and fit it into the worksheet. The worksheet is the common organizational structure that we are always going to use to help us answer the two important questions. What is our pension expense for the year, and what is our net pension asset or pension liability that needs to be disclosed on the balance sheet? Okay, so we have the beginning balances, and then the rest of this, or the middle part of the worksheet then, is to identify the components that may have an impact on some of these account balances. So for example, if we have unamortized prior service costs, that means that the employer made a modification to the plan of some sort, and GAAP allows for the total cost, the total anticipated cost of those changes to not be recognized in full in the year in which those changes are made. In other words, if we make a change to the plan that causes the projected benefit obligation to go up by $100,000, we don't have to recognize all of that in the year in which we made that change. GAAP allows us to amortize that expense, that cost, over time. And it's up to a firm. They have a lot of flexibility, a lot of freedom in terms of how to amortize the period of time over which to amortize those service costs. And we're not going to get into all of that. That has to do with the actuarial information. But the point is, if we have unamortized prior service costs, then we will probably be amortizing some portion of that each year, and we need to know how much. So I go back to the problem, and we can see that there are prior service costs. Here's the $80,000 balance, and we're told that the 2013 amortization is $8,000. So that's what I'm going to amortize. Now, amortization, remember, means reducing the balance of an account. So if unamortized prior service cost has a debit balance, and I'm going to amortize or reduce that balance, I need a credit entry in order to do that. I need a corresponding debit entry somewhere, and the only allowable place on the spreadsheet for a corresponding entry is under the annual pension expense. And so each one of these lines, items B through I, will be self-balancing. The debits and credits must be equal. Even though we're not really creating journal entries, we are creating the elements of a journal entry. And each one of these lines, I've specifically designed the spreadsheet so that this is ensured that each one of those lines will be self-balancing. So if I'm going to create an $8,000 credit entry here, then the only place to put a corresponding debit, in this case $8,000, is in the annual pension expense account. There's also then amortization of gains and losses on PBO estimate revisions. Those don't occur very often, but can happen. And there are also actuarial gains and losses. Those happen even less often than these amortization of gains and losses here. So both of these items, C and D, generally are captured in this net gain or loss carry forward in AOCI account. And we just have to read the problem to determine whether the amortization is related to an actuarial gain or loss, or if we're actually amortizing a pre-existing gain or loss. So we have net loss, AOCI, amortization is $1,000. There's the beginning balance of 101, and we are going to amortize by $1,000 this year. Once again, amortization means reducing the balance. And so if I'm going to amortize this account, it has to be a credit entry. I've got a net loss that's being carried forward, and I'm going to reduce that loss by $1,000. So if I'm starting out with a debit balance here, and I want to make that balance smaller, I have to create a credit entry. That means that I'm going to need a $1,000 debit entry to balance this line item here. There was no mention in the problem of any sort of actuarial gains and losses. Actuarial gains and losses occur when the actuaries change some of the underlying assumptions that they use to determine the projected benefit obligation. So for example, if new mortality tables come out and we revise the projected benefit obligation based on an increase in the average expected life of retirees, that would result in an actuarial gain or loss. If we adjust the discount rate by which we are discounting the projected benefits, that would be an actuarial gain or loss. Again, that doesn't happen very often and very rarely in the problems that we'll be looking at, but I did design the spreadsheet to be capable of handling those kinds of issues. All right, so again, I go back to the problem here. There's no mention in Sterling Properties of any sort of actuarial gains and losses that have been generated. So I'm just going to put little lines in here to indicate that I've considered that information, but that there are no gains or losses. And now we begin to sort of get to the core changes that affect the pension expense accounts and projected benefit obligation. First of all, service cost. Service cost is a recognition of another year's worth of service being provided by the employees, and that they now have an additional year's worth of benefits that have accumulated. The actuaries will take that information, figure out the discounted present value of that additional service cost, and it needs to be added to the projected benefit obligation. Again, in this class, we're not going to get into all the actuarial issues, but we can see that service cost for the year is $112,000. So I need to add $112,000 to my projected benefit obligation. That means that I need to also recognize a $112,000 debit entry on this line in the pension expense account. So my employees have worked another year and have accumulated $112,000 of additional benefits, and that does need to be recognized in the expense account this year. Interest cost is the reversal or partial reversal of the discounting effect. The projected benefit obligation is the net discounted cash flows or expected benefits for our employees. Well, now that we are another year closer to the future, so to speak, we begin to amortize that discounting effect. And the way that the interest cost works is we take our discount rate or our interest rate that's assumed in the analysis, and we multiply that by the beginning balance of the projected benefit obligation. So let's take a look and see what our interest cost is, or the discount rate is, for this particular problem. So the interest rate in this particular problem is 6%. And so in order to recognize the amortization of interest, I would take 6% of my beginning balance in the PBO. So I'm going to get my calculator up here and take 6% times the beginning balance of my PBO, which is $850,000. And we can see that my interest amortization is going to be $51,000 this year. And so what I will do is credit my PBO by $51,000. That is the partial reversal of the impact of discounting. That $51,000 credit entry needs a corresponding debit, and again, that will go into the interest expense account. Next, we have expected and actual rate of return. Remember that one of the things that we do is the employer and possibly the employees are making contributions throughout the year to the plan assets. And that plan administrator is investing those plan assets and hopefully generating a positive rate of return on those plan assets. And here's where things got a little bit messy in US GAAP. Firms were really concerned about volatility in the returns on plan assets. Some years return on plan assets could be really good. In other years the return on plan assets might be significantly less. And management of firms were concerned that that sort of volatility would have a major negative impact on the amount of pension expense that needs to be recognized. And so they convinced the Financial Accounting Standards Board to allow firms to credit the pension expense account for the expected rate of return, and yet the plan assets are going to increase by the actual rate of return. Now, in years where the expected rate of return and the actual rate of return are different from each other, of course, that's going to lead to an imbalance in this particular line item. And we'll get to how to resolve that in just a moment. But the key there is that the credit to the annual pension expense account is going to be based on the expected rate of return, long-run expected rate of return. That's based on assumptions made by management and the actuaries. And the debit to plan assets is going to be based on the actual rate of return. So we need to know both of those. And if we go back to the data here, we can see that The expected rate of return is 10%. Long range or long run expected rate of return on plan assets is 10%. Plan assets started out with a balance of $900,000. So 10% times $900,000 is a $90,000 credit entry to the pension expense account. The actual rate of return, plan assets actually did a little bit better than expected. The plan actually returned 11%, not 10%, and so that's pretty good. So we can take 11% times 900,000, and we see that the actual return on plan assets was $99,000. Okay, and so what do we do with that information? Well, that goes into our worksheet here. The expected rate of return, or the expected return on plan assets, is our credit entry to the expense account, which in this particular case is 90. That was 10% times the plan assets. The 99,000 actual return on plan assets goes in here as a debit entry to the plan asset account. And notice here I need to balance this journal entry, or this line item, and that means that I need 9 more credits, $9,000 more in credits. So I have 99,000 in credits, 99,000 in debits. This credit entry goes into a net gain or loss carry forward in AOCI. So since there's a difference between the long range expected return and the actual rate of return, that difference is allowed to temporarily go into shareholders' equity as a part of accumulated other comprehensive income. And so that's one of the other uses of this net gain or loss carry forward. It's kind of a catch-all account where we temporarily hold some of these miscellaneous gains and losses that are associated with pensions. Okay, the last two items are fairly straightforward. There are cash contributions. The employer and possibly the employee are making contributions to the plan. Remember that that information was not provided initially in the problem, and I added that, we have $50,000 of contributions that have been made. So we're just going to assume that that's taking place. So I've got a $50,000 credit entry here to cash, and that $50,000 is going into the plan assets. And then also benefits paid. Benefits are not paid out of the cash of the company. They're paid out of plan assets. That's why we have this plan administrator, to accumulate the assets that are necessary to make good on the promises that we've made on the projected benefit obligation. And I decided, I think, that we had $70,000 in benefits being paid out. So benefits being paid out of the plan assets, that's a credit entry to plan assets. And then a debit entry, it's a reduction of the obligation. We are paying off some of the benefits, not all, but making good on some of the benefits that we promised, and that's a reduction of the projected benefit obligation. So now we've completed all of the data elements. If we go back to the problem here, we can see I've dealt with service costs, dealt with the PBO, dealt with plan assets, prior service costs, the net loss, incorporated the interest rate, incorporated the expected rate of return, the actual rate of return, and then we even added the two additional elements of $50,000 in contributions and $70,000 in benefits paid. And so now I can complete the worksheet. Here's where we sort of have to look at this as a puzzle. My general rule of thumb is to complete the plan administrator accounts first. I've got a $900,000 beginning balance, and then I have some debits and one credit to that account, and I just figure out what the new balance is based on those changes. So it starts out with a $900,000 debit balance, increases and decreases, 979 million or 979,000 debit balance. And I do the same thing with the projected benefit obligation. Start out with 850,000. A couple of items increase the account. It's a credit balance account. Credits increase it, debit decreases it, and I figure out that I have $943,000 in credits. Once again, this difference is what will show up on the employer's balance sheet. So these are the ending balances of any of my balance sheet accounts and plan administrator accounts. So I'll get a statement from my plan administrator that tells me my plan assets are 979, my PBO is 943. The difference between those two goes right here, and that results in a $36,000 debit balance. So I'm still overfunded. Sterling Properties is still overfunded on their pension system. They are less overfunded than they were to begin with, but nevertheless still overfunded to the amount of $36,000. Now, from there, I can begin to fill in this summary journal entry. This box that's highlighted here, that's the summary journal entry. And all I have to do is take all the debits and credits in this column, items B through I, and add them up. So I've got some debits to pension expense, one credit to pension expense, and that all adds up to an $82,000 net debit entry. So there's some items causing pension expense to increase, one or more items causing pension expense to decrease, and the net impact on pension expense this year is $82,000. I also have a net $50,000 credit here to cash. In fact, that's the only thing I did to cash was credit it by $50,000. I amortized part of the previous carry forward in AOCI and then added to that, or had an impact on that account. That's a net $10 credit entry to this account. Remember, this is the beginning balance. These are the changes in here. Items B through I are the changes, and that's what I'm adding up to get my summary journal entry. And then the same thing for unamortized prior service cost. I just had the one entry that's an $8,000 credit balance or credit entry, so I just bring it down here. And here's where the puzzle begins to fit together. This line, this summary journal entry, has to balance, and this also has to work. I have to know that I can get from $50,000 debit balance to a $36,000 debit balance. So this intersection right here, this cell, is what helps ensure that I've organized the data correctly and that I have the correct ending balances and all of that kind of stuff. It's very unlikely that I can get one number that will make this line work and the same number make this column work with having errors. It's just not going to be possible for that to occur. So you can see here I've got 82,000 in debits so far, 50, 10, and 8 in credits. In order to end up with $82,000 in debits and $82,000 in credits, I need a $14,000 credit entry. That will get this line, this summary journal entry, to work. Also, $50,000 beginning balance minus $14,000 gets me to $36,000 debit balance in my prepaid pension asset account. So this column works as well. So that's sort of the last puzzle piece, so that I know that everything fits together the way it's supposed to fit. And so now that I've completed the worksheet, now I can move on to completing the problem in terms of answering several important questions. Remember that the objective here is to identify two things in particular. One is, what's the net pension expense that shows up on the income statement, and what's the net pension asset or liability that shows up on the balance sheet. Well, this worksheet now tells me that information. $82,000 is my pension expense, and $36,000 is my ending balance of the prepaid pension asset account. Now I can get the balances in some of my AOCI accounts as well. So I start out with a $101,000 debit balance in the loss carry forward, credited that account for a net of $10,000. That leaves me with a $91,000 debit balance. And prior service costs started out with an $80,000 debit balance. I credited the account for $8,000, and so that leaves me with a $72,000 debit balance in that account. So I can complete those AOCI balances as well, but the really two most important ones are the balance in the prepaid pension asset or accrued pension liability account, and what is my pension expense for the year. Now, to kind of complete this, here's my adjusting or my summary journal entry. Debit to pension expense of $82,000, and then in this particular case everything else turns out to be credit entries. That's just a copy of what is right here in this box. And then the balance sheet disclosure is based on what happens right here. These are my ending balances, and these are my balance sheet accounts. So for Sterling Properties, I have a net prepaid pension asset of $36,000. It's a debit balance in that account, so it shows up as a prepaid pension asset. If it were a credit balance, it would show up as a liability, but it's a debit balance, so it's on the asset side of the balance sheet. And then the two AOCI accounts also have to show up here. AOCI, Accumulated Other Comprehensive Income, is part of shareholders' equity. And so the two account balances, $91,000 and $72,000, are both going to show up as a part of shareholders' equity. Notice that these are showing up or appearing as negatives to shareholders' equity. Shareholders' equity accounts typically have credit balances. These two AOCI accounts for Sterling Properties happen to have debit balances. Debit balances in shareholders' equity are negatives. So we have to make sure that we properly disclose not only the dollar amount of the balance, but the direction, the impact on shareholders' equity. So that's exercise 8. I realize that this was a fairly lengthy video, but it's a complete analysis of working through that pension expense worksheet.